Good afternoon. We've had a lot of requests for some of the books we reference in our videos and where to find some of that information. Some of the data is research-based, and you can email us for that information, and others is posted in our website and also in our Vimeo page and also on our LinkedIn page. So there will be links to those books and all those authors that we reference in a variety of videos. Hope you enjoy the video today, how fees can impact the value of an asset. Today we're going to talk about how fees distort markets part 2, which is really about how fees distort market values, which again is kind of odd, right? Doesn't a thing have an intrinsic value? How could a fee distort that value? Well, if you think about fees in terms of risk and reward, which we know is related, right? Risk and return. It's also got this third element of value. So where we perceive risk also drives value. So if you look at this kind of simple graph, if you fix outcome, which is really kind of a reward issue, right? And you make risk low, well, low risk means high demand. High demand means higher valuation. So high value relative to the outcome means lower yield. So that's what that looks like when we fix outcomes. On the other side, low value would be a higher risk asset. So the yield potential is tremendous, right? Now, if outcomes were fixed, this would be a no-brainer. You do this, but the truth is that outcomes are not fixed. They're more like waves. It kind of gets more and more volatile and tighter the further you go, with the potential of outcomes being dramatically different the further you go down the scale, right? So the perfect example of this is with the CDOs, the Credit Default Obligations during the housing boom. Moody's and S&P rated these as low risk, AAA rated risk. There's actually memos in S&P's files from as early as 2005 where they actually assess the risk of a housing value drop at 20% value drop as extremely high, right? So that doesn't sound like low risk. A 20% drop in value is actually pretty close to what actually happened. It was, I think, right around 26 to 28% drop in values that caused this kind of chain reaction. So why would they rate them AAA? Well, the fees they were paid grew 800% growth in CDO fees during the housing boom. And Moody's, in their shareholder meetings, actually had stated to their shareholders that the quality of their ratings had nothing to do with their profitability. The problem for Moody's is if they rate them accurately, then everybody goes to S&P, and vice versa for S&P. If they rate them accurately, then everybody goes to Moody's. So the profit motive of those companies drove their decisions, at least influenced their decisions on where to measure that risk. It turns out that we will ignore risk if it impacts our livelihood, right? That makes perfect sense. In the signal and the noise, they talk about this. Nassim Taleb talks about this too, having skin in the game. Even after the crash, Moody's profits were off the charts. Even up into 2010, they had extreme profit relative to the amount of downside they could have borne had they participated in the risk that they assessed. So alignment in measuring risk is really important. So that happens in public markets, but also it happens in private equity and real estate funds. That 2% fee drives bad risk assessments. So if you raise a fund in a niche market, say a $100 million fund, and you deploy that capital and you have success, then you're raising a $500 million fund and then a $1 billion fund. The problem is the bigger the fund, the harder it is to deploy capital efficiently into niche markets. So what typically happens is you move upstream, bigger and bigger properties. The competition for bigger and bigger investments is extreme. 82% of financial assets held by baby boomers as they move into passive investment phase. All that liquidity is in the market, plus low-cost debt. So with all this money chasing deals at bigger and bigger levels, you get into this competitive bidding situation. So if you can't find an investment that you think fits your risk profile, what do? Do you deploy the capital or do you give it back? Well, I've just built all this infrastructure based on this 2% fee. That is my livelihood, right? So I need to keep that. I'll go ahead and make bigger bets on risk. Valuations in PE went from 11 times EBITDA, which is extraordinarily high, in 2018 to first quarter of 2019, 12 times EBITDA. There's a reason why Warren Buffett is sitting on $122 billion of cash, which is his highest cash reserves in the history of that company. So finding value in an inflated market is difficult. And the bigger you get in these funds, the harder it is to deploy that cash. We know a specific fund that raised $1 billion after raising a few niche funds, raised $1 billion, made 26 offers on companies in 2018, won none of them. Now what do? Can't give that money back. Gotta keep collecting my 2% fee. So now I'm gonna take great risk because I don't actually bear the cost of the risk. I get rewarded regardless of the risk I take. There's a misalignment. So the whole goal is create alignment in your structures regarding the fees. Even third-party fees can impact valuation with a miscalculation of risk. I hope that's helpful.